Who doesn't know Apple? The largest and most successful technology company in the world. Everyone has had an Apple product in their hands. But what do you need to know about Apple if you want to invest in it? So let's start from the beginning. Apple was founded in 1976 by Steve Jobs, Steve Wozniak, and Ronald Wayne, with starting capital of just $1,300. To date, Apple has grown into the largest publicly traded company with a market capitalization of over $2.6 trillion. The introduction of the iPhone in 2007 made a major contribution to the success and still accounts for the majority of Apple's revenues today. But Apple also offers many other products in addition to the iPhone, such as MacBooks, iPads, headphones, and much more. In addition to the technical devices, Apple also offers services such as Apple Music or Apple TV Plus. But Apple isn't just Apple. Apple still owns numerous subsidiaries. These include, for example, Shazam, Claris, Anobit, Authentech, and Beats Electronics. As a result, you can clearly see that Apple is much larger than you would think at first glance. Next, we will take a closer look at Apple and find out how the finances are and whether an investment is worthwhile. The majority of the shares are held by institutions and the general public, while private companies and the government hold a relatively small percentage of shares. Individual insiders and public companies hold a moderate amount of shares. And the shareholders have not been meaningfully diluted in the past year, which is a positive signal. Let's move on to the analysis. According to our analysis, Apple is currently trading above our estimated fair value of $119.91, with a current market price of $165.60. This indicates that the stock may be overvalued in the current market. Also, other fair value calculations beside the discounted cash flow are on average indicating that Apple is trading above the fair value. When a stock is trading above its fair value, it may not be the best time to buy, as there is a possibility of the stock price correcting to its fair value in the future. Investors should exercise caution and do their due diligence before making any investment decision. The financial metrics for the given company are as follows. Piotrowski F score is 6 out of 9. This score is based on various financial metrics such as profitability, leverage, operating efficiency, and cash flow. A score of 6 indicates that the company is in good financial health, but there is still room for improvement in certain areas. Altman Z score is 7.63. This score is used to predict the likelihood of a company going bankrupt. A score above 2.99 is considered safe, and a score below 1.81 is considered risky. With a score of 7.63, the company is considered safe from bankruptcy. The Beneish M score is 2.82. This score is used to detect earnings manipulation. A score above 1.78 indicates a high likelihood of earnings manipulation, while a score below 2.22 indicates a low likelihood. With a score of 2.82, the company is considered to have a low likelihood of earnings manipulation. WACC versus ROIC. Here, the weighted average cost of capital is 8.95%. while the return on invested capital is 31.47%. This indicates that the company is generating returns that are significantly higher than its cost of capital. This is a positive sign, as it suggests that the company is using its capital efficiently to generate profits. Overall, based on the given financial metrics, the company appears to be in good financial health, with a high Altman Z score and a low Beneish M score. Additionally, the company is generating returns that are significantly higher than its cost of capital, which is a positive sign for investors. However, there is still room for improvement in certain areas, as indicated by the Piotrowski F score of 6 out of 9. From the technical site, we see that most indicators are on buy, and from our momentum model, it's in the 5 years chart also a buy. So, the lights are green for this part. From these information, we can go over to our conclusion. The company has strong financial fundamentals with high margins before interest, taxes, and depreciation, and among the highest profit margins of all publicly traded companies. Its business is highly profitable, with an excellent financial situation and significant investment capacity. The majority of analysts following the stock recommend buying or considering it, and their estimates for business activity development are relatively similar due to the company's good predictability and excellent communication with analysts. Additionally, the company has a history of exceeding analysts' expectations when reporting balance sheet results. These strengths demonstrate the company's ability to maintain profitability and drive growth in the future. On the other hand, the company faces some weaknesses, including an average growth rate indicated by the expected revenue development over the coming year. Its P ratio of 27.68's company earnings for 2023 puts it at a relatively high valuation level, and its enterprise value sales ratio is among the world's most expensive companies. Given its balance sheet size, the company appears to be highly valued, and its valuation level is particularly high in light of the cash flow generated. Furthermore, recent revenue forecasts for the current and upcoming years have been lowered, suggesting potential challenges ahead. And the business model is highly dependent on the iPhone, which make 521% of the revenue. However, despite these weaknesses, the company's strong financial position and profitability demonstrate its potential to weather any short-term setbacks and continue to deliver long-term value for investors. So the company has solid fundamental data. More than 70% of companies have a weaker mix of growth, profitability, debt, and predictability. The majority of analysts recommend buying the stock due to its good predictability and history of exceeding expectations. However, the company also faces some weaknesses, including an average growth rate and high valuation levels relative to its balance sheet size and cash flow. Recent revenue forecasts have been lowered, indicating potential challenges ahead as the upcoming higher yield